Hey everyone, and welcome back to our solution series for the 2010 UP PGT economics paper. This is part 3, and if you've been following along, you know we've already knocked out the first 20 questions. Today, we're jumping right into the next set.
All right, so in this session, we're diving straight into questions 21 all the way to 30. We're not just going to give you the answers, we're going to break down the logic behind each one so you really understand the concepts. Ready? Let's do this. Now, to make these next 10 questions a little easier to digest, we've actually grouped them into 3 main themes. We'll start with a few on consumer theory, then we'll switch over to producer theory, and we'll wrap up with some really important questions on Keynesian economics. Okay, let's kick things off with our first section, consumer theory. We're going to explore 3 key questions that deal with demand, elasticity, and utility. First question on the docket. When the elasticity of demand is unity, or, exactly 1, what does that mean for marginal revenue? Is it positive, negative, or 0? So take a second and think about how those 2 concepts are connected. And the answer is 0. This chart right here lays it out perfectly. It's a really important relationship to remember. When demand is elastic, meaning elasticity is greater than 1, your marginal revenue is positive. When demand is inelastic, or less than 1, MR actually turns negative. And right at that sweet spot, where elasticity is exactly 1, that's unitary elastic, your marginal revenue hits precisely 0. Okay, on to the next one. When you're out shopping and you decide to buy something, what is that price you're willing to pay actually equal to? Is it the total satisfaction you get, or something more specific? You got it. It's the marginal utility. It all comes down to a core principle, the law of equi-marginal utility. Basically, a smart consumer will keep buying a good up to the point where the price they pay equals the satisfaction they get from that very last unit they consume. All right, last question for this section. This one's about a very specific shape of a demand curve. If you see a demand curve that looks like a rectangular hyperbola, what can you say about its elasticity? This one's actually pretty simple. It's equal to unity. This isn't something you calculate, it's a core definition. What makes a rectangular hyperbola demand curve so special is that, by its very nature, the price elasticity of demand is always equal to 1, no matter where you are on that curve. Definitely one to lock away in your memory bank. All right, let's switch gears and look at things from the other side. Now we're moving into producer theory, with questions about costs, firms, and the markets they compete in. So, question 26 wants to know about the relationship between 2 types of costs. When marginal cost is on its way down, where is the average cost in relation to it? Is it lower, higher, or the same? Now hold on, this one is super important and a bit tricky because the official answer key actually gets this wrong. It says the answer is less than, but just look at the graph. You can clearly see that in the entire region where the MC curve is falling, the AC curve is still floating above it. So the correct economic principle is that when marginal cost is decreasing, average cost is greater than marginal cost. Next up, let's talk about market power. So how do we actually measure, how much monopoly power or imperfection there is in a market? Which of these formulas does the job? And the formula you're looking for is price minus marginal cost, all divided by price. This has a name, of course. It's the Lerner index. It's a really neat way to put a number on a firm's market power. The closer that number gets to 1, the more imperfect the market is and the more monopoly power that firm has. Okay, wrapping up this section with one last cost question. Marginal cost is not related to which of these things? Total variable cost, total fixed cost, or total cost? And the answer is total fixed cost. Think about it. Marginal cost is all about the cost of making one more item. Your fixed costs, like your factory's rent, don't change whether you make 1 item or 1,000. They're fixed. So they have absolutely no bearing on the marginal cost. It's all about the change in variable costs. All right, time for our final section, and it's a big one, Keynesian economics. We're going to dive into some really fundamental ideas about income, multipliers, and the role of monetary policy. Okay, picture this. Investment spending in the economy is stable. It's not changing. What happens to the overall national income if people suddenly start trying to save more of their money? Well, you might think saving more is always good, but here's the twist. Income actually goes down. This is what we call the famous paradox of thrift. Keynes pointed out that if everyone tries to save more at the same time, it means they're spending less. This drop in consumption reduces aggregate demand for goods and services, and that ultimately leads to a fall in the national income. It's a bit counterintuitive, but super important.
Okay, let's crunch some numbers. We've got two related calculation questions coming up, one on the investment multiplier and one on the marginal propensity to consume, or MPC. Let's tackle them together. First up, question 25. We're given that the marginal propensity to save, or MPS, is 0.4. The formula for the multiplier, K, is just 1 divided by the MPS. So 1 divided by 0.4, that gives us 2.5. Easy enough, right? Now, for question 27. The change in income is 5,000 crore, and the change in saving is 500 crore. So first, we figure out the change in consumption, which is just 5,000 minus 500, so 4,500. Then we plug that into the MPC formula, which is change in consumption over change in income. 4,500 divided by 5,000 gives us our answer, 0.9. Okay, another big-name concept here. Who came up with the idea of the liquidity trap? Of course, that would be the one and only John Maynard Keynes. The liquidity trap is a really interesting idea. It's a situation where interest rates are already so incredibly low that lowering them even more doesn't do anything. People just choose to hold onto their cash instead of investing it, which means that money gets trapped and the central bank's main tool becomes totally ineffective. So there you have it, the solutions for questions 21 to 30. But before we go, here's a little something for you to think about. How else could these same theories show up on your exam? What other kinds of questions could be built around consumer choice, producer costs, or those big Keynesian ideas? Chewing on that is a great way to study. We'll see you in part 4. Until then, keep learning.